In this, the first of 3 videos on options, we're going to basically discuss the techniques, right, or the process, if you will, of how we determine values. So exactly how do puts and calls react, or how do they perform? How do you calculate returns? So that's the process we're going to start with very intermediate, introductory discussion of calls and put options. There are obviously financial assets, but they represent a claim on another asset. This is what we refer to as a derivative securities. So stocks, bonds, and convertible types of securities are what we refer to as financial assets. And an option is the right to buy or sell an underlying asset, such as common stock, at a fixed price for a certain period of time. So the contracts, refer to them, there are 2 types. One is a call and one is a put. A call enables the holder to buy an underlying stock at a certain price for a certain period of time. If you think about investing in stocks, when would you want to buy a stock? You would buy a stock when you think that the stock price is going to go up. That is the exact time you would also consider possibly buying a call. A put is when you purchase a security, but in this time, you have the right to sell the security at a certain price for a certain over a certain period of time. And a put is used exactly like a short sale is used when you purchase securities. If you think the stock price will go down, instead of selling the stock, maybe you want to maintain it because you want to maintain your portfolio, instead of selling the stock, you buy a put. And again, we've referred to these as derivative securities. They get their value from something else. Now, the owners of puts and calls, people that buy these, they have no voting rights. They have no ownership in the company. They don't get interest and they don't get dividend income. All you are purchasing is the right to act in the future. So the option premium is what we refer to as the price to buy the option. That's equivalent to saying the stock price. That's what we refer to as the option premium. And again, an option allows buyers to use leverage. So what do we mean by leverage? The option is going to move in value the exact same way the underlying asset is going to move. But the difference between the two is the price. So imagine you could buy a stock for $100. If that stock were to go up by $10, you'd make 10%. But what if you could buy an option, a call option, for a stock with a strike price of 100, but it has a premium of $1. So if the stock price goes from 100 to 110, your option value goes from $1 to 11. So you made $10 on a $1 investment. So that is what we refer to as leverage. So there's a greater percentage change in the stock price, or excuse me, a given percentage change in the stock price creates a bigger percentage change in an option's value. So what's the difference between sellers and buyers of options? Puts and calls are different from stocks. Stocks are created by companies. Puts and calls are created by investors. So although it's not correct to really say, if you want to, you could think of an option as a bet. So if you buy a call, you are betting that the stock price is going to go up beyond the strike price. If you buy a put, you believe that the stock price will go down below the stock price, the strike price. So the person who's buying this, they're placing a bet. Well, who do they place a bet with? They place a bet with the option writer or seller. What they receive is they get the bet. So they receive the premium from the buyer. Now, what happens? They have the obligation to sell or buy the underlying asset according to the terms of the contract. So if they buy, or excuse me, if they create a call, if the stock price goes up, eventually they're going to have to buy this stock from the person who has the right, they're going to have to buy it from the person who has the right to buy the stock in the end, or they're going to have to sell it to them in the end. Again, this obligation is legally binding. That is, the seller can't walk away from this deal if it turns out to be a loser. So if you think about the betting proposition here, I mean, one of the challenges is that people could renege on the deal, right? They could say, nope, I'm lost money, so I'm just not going to participate, or I'm not going to sell this option, or follow through with their part. Now, what happens is this actually goes through what's referred to as a clearinghouse. So you really don't know who you are placing your bet with. You just know you are placing a bet. And then the option house, the clearinghouse, ultimately finds somebody who will complete the transaction when you want to exercise your right. The buyer, again, has the right to buy or sell, again, at a fixed price within a given period of time. Of course, they have to pay for this right. So they pay the premium. Again, they do not have to exercise their options. They can walk away if the option isn't profitable. So the person who sells this, who in quotes creates this option, whatever happens, they must follow through with that transaction. But the person who buys the right, again, you're purchasing a right to act, you can choose not to act. Puts and calls trade in an open market. We just talked about that a couple of seconds ago. Essentially, they're traded through a clearinghouse, and essentially they're bought and sold through securities and brokers. So let's think a little bit about how they work. And we've talked about this, but we're going to review just a little bit. For a call, the person who buys a call wants the price to go up. The person who sells the call wants the price of the asset to go down. So if you kind of think about it, the seller creates or writes the option. So they say, hey, look, I think the option is going to stay right where it's at, or it's going to go down. If that's what they think, they are going to create a call. They're going to then have to find somebody who thinks the price is going to go up so they can place this bet. So the seller wants the price to go down, the buyer wants the price to go up. And the actions of puts are the exact opposite. The buyer expects the price to fall. Now they want it to fall far enough so that they make profit. And we'll talk about how we calculate profit in a couple of minutes. The seller of this, in this case, expects the stock price to ultimately go up or at least stay the same. So puts and calls are very similar to buying and selling stocks. You want to buy a call when you think the price will go up, and you want to sell or buy a put when you think the price is going to go down. So let's work our way through some basic little examples here. If the price of an asset goes above its stock price, if you buy a call, then the option person is going to buy the asset. So they're going to buy this price or buy the stock at the strike price. So if we have an option that has a strike of 50 and the price goes to 55, then you would have a right to buy the stock at 50. But you could then immediately sell the stock for 55. So the writer then is the person that's ultimately then going to have to sell the asset to you. So if they don't already own this asset, then they're going to have to go out to the marketplace and purchase this stock at a higher price. So they have this stock. If they don't own the stock, they're going to have to go out and buy it at 55, and then by rights, they're going to have to sell it to you at 50. So they're going to lose the value of the option itself. They're going to have a loss on that transaction. Now, they can do this as what's referred to as a covered call or a naked call. For a covered call, the seller owns the asset. So all they'll have to do is give you the asset. But if it's a naked call, that's where they have to go out and purchase the asset in public. If the price of this asset goes down, that means the person that bought the call was wrong. And of course, they're not going to exercise the right. So what they did is they paid this premium, and they'll lose the premium. But that's the most that the person who buys an option can lose, is the value or the premium that they paid. Of course, the most that the person that writes a call or an option can make is the premium that they receive. So here we have an example. We have a market price. The stock price is 50, right? Going to buy 100 shares of stock. You have the right to do that at a strike price of 50, and it costs $500. So essentially, it's $5 per share is the premium. If the price goes to $75, the investor's going to exercise the right. So they're going to purchase 100 shares for $50, and then, of course, they're going to sell it for $75. So what profit did they make? Well, they made a gain on the sale of the asset, right? They purchased it for $50, but they sold it for $75. So they'll make $25 on each share of stock. Multiply that by 100, that's obviously $2,500. But they paid $500 for the investment. So their profit is $2,000. Now the option seller's loss is going to be the exact same. They lost $25 on each share, times 100 is $2,500, but they received $500. So when we think about options, we think that it's what's referred to as a zero-sum game, right? In the end, the profit of one side of the coin is exactly equal to the loss on the other side of the coin. So how does this work when you think about calculating returns? So the return on this investment, you think about the call option, right? You made $2,000, but you only paid $500. So you made a 400% rate of return. But if you had bought the stock itself, you would have bought 100 shares at $50 a share. That's $50,000. You made $2,500 in profit, so you made 5% on your transaction and your investment in this particular stock. So this is the example, if you will, of how you calculate profit and then how you calculate returns. And as you can see, the option, because you invest such a small amount, right? It costs $5 to buy the right compared to buying $50 to buy the stock. You have inflated rate of return on your investment. So again, how can we calculate this out? Again, as if you assume that the stock price is $50, you bought the call for $100, strike price 50, the option's 500. Again, if the price went down to $25, well, you paid $500 on this, and because you would never buy the stock at 50 and then try to sell it at 25, you would let this exercise lapse. So you would not exercise the option, but you did pay $500. The option seller, the person that wrote this option, that made the bet with you, if you will, they would make $500. So how do puts work? They work the exact opposite. The buyer of a put wants the price to go down. The seller expects the price to go up. So if the underlying price goes below the put option strike price, the put owner is immediately going to go out and buy the underlying asset. They'll pay the market price. That will then force the put seller to buy the asset at the higher strike price. So they have the right to sell it. Again, if the strike price is $45 and the stock price goes to 40, right? You have the right to sell it for 45, but they have to buy it for 40, which means in the end, you make $5 on the sale. And we'll see that math here in a second. Again, if the price actually goes up, just as before, the buyer of this option is going to not exercise the option, and the seller is going to keep the option premium or the bet that was placed. So in our example here, we have the same price, $50. $50 is the strike, $500 is the premium. Now in this case, if you notice the formula, it is written in the opposite direction. The strike price, $50 minus $25. So that's $2,500 is what you make from the transaction on the stock. But of course, I paid $500. So in this case, the buyer is going to earn $2,000 and the seller is going to lose $2,000. When we look at the returns, what if the stock price went up instead of down? Again, the buyer's loss is going to be the premium because they are not going to go out and sell this stock for 25 buy this stock. They're not going to sell it for 25 so they can go out and buy it for 75. So the idea here is the buyer's loss is going to be that $500 premium and the seller is going to have $500 in profit. So the advantages and disadvantages of calls and options in general is the leverage is the largest of the advantages. You invest a very small amount and your return moves in the exact same dollars as what the higher priced stock itself or other asset goes. And again, you also can make investments and you can make money whether the stock price goes up or down. The disadvantage is that the holder, right, you don't get interest, you don't get dividend income, you don't get the vote, so you don't have any ownership rights. Options do expire. They only have a limited lifespan, and it's relatively short term. The longest term that you can typically buy a regular option is 90 days. Options are very risky, right? A small change in price can make an option ultimately worthless. So there are advantages and disadvantages. An investor, especially a beginning investor, should be very concerned and very conservative when it comes to investing in options.